Okay. Hello, everyone. Thank you for joining us. This is Investment for Beginners, episode 6. We're going to talk about something I'm quite passionate about, which is SaaS stocks, whether they're cheap, expensive, and how to think about this opportunity. So my name is Michael from Deep Value Returns on Seeking Alpha, and I have a premium newsletter that talks about investments with a hybrid idea that you split the portfolio in half, and half of it goes towards value stocks and half of it goes to growth stocks. So Manuel, over to you.
And I'm Manuel Maurício, and you can find my work over at allinstocks.com. Michael, I'm really interested in your theme today. Let's do it. What are you bringing us?
I'm going to talk about SaaS stocks. Now, SaaS has become a catch-all. It's basically very broad now because initially the SaaS was subscription services. But now it's
software as a service.
Software as a service. But now it's kind of split out because you have platforms as a service and you have software as a service, and then you have what people even consider, which, something like Peloton, which is not software, but a subscription service. People will say, oh yeah, it's kind of like SaaS. People kind of just started kind of bundling this all together, and it's become like
everything's as a service right now.
Everything is as a service. I mean, IBM actually has this segment that is just called as a service, like just to try and catch some of that premium valuation. I don't know if you follow IBM.
No, I don't.
Sometimes I kind of just look at it.
But this could even be a Seinfeld episode. Where are all the products? Everything's service now.
Yeah. So basically, there's a lot of investors' appetite for these SaaS names. So I kind of got interested. So my idea is that if you're willing to do a bit of more work than everyone else, and you kind of spend a bit of time over the years with something that's quite interesting, you're quite passionate about. So you don't want to kind of be spending too much energy in something that you're going to fizzle out. You need to kind of spend a lot of energy on something that you're going to continue spending next 3, 4, 5, 10 years studying. That's how investing is, and that's how you're going to get really, really good at this. You're going to kind of cut out a niche for yourself so that it becomes like a second sense. It's like your sixth sense. You're able to kind of understand very, very quickly what's fairly priced and what's not. And if you it's like cycling or any other sport you do, whatever it is, playing chess, whatever, if you do this every single day, for a period of 10 years, it's inevitable that you're going to become fairly okay. Malcolm Gladwell talks about 10,000 hours. Other people have also talked about it. But essentially, this is it. So if I kind of was quite passionate about trying to understand this SaaS-like businesses because the world is moving, right? The world is moving towards online opportunities. And ultimately, it's those kind of older business models that everyone understands, like cigarette companies. They're not going to be the most promising opportunities over the next 20, 30 years. So you might as well adjust to the current. You might as well kind of try and position yourself to where things are going. And even if you're not very good today, if you spend the next 3 years doing this every single day, at some point in time, you kind of things become a bit more kind of clear to you. It's inevitable, right? It's like I might not be able to know much about design, but if I spend so much time doing it, and there is a few key metrics that people look at in SaaS. Okay, so I'm just going to run through 3 key metrics that I find helpful to think about. Hopefully, the listeners will also find quite helpful, and it's just to cut away some of the noise, because I was reading Michael Lewis's Moneyball. And Moneyball is an interesting book because it kind of shows to you that if you just look at the hard numbers, and it's about baseball, but it could be anything, and you take away the narrative and you just focus on the price that you're paying for the player relative to what the player has a history of doing, things work out favorably. Sometimes the narrative is not very strong for that particular player or that particular company, and you get a reasonable discount to what the company or the player could be worth. Now, the point I'm trying to make is that you don't need to kind of find a new SaaS business every single day, or even every single week, or even every single month. But if you find one idea every 3 months, and you just kind of start buying into these new positions in a 6-month period, something can happen positively, okay? So one of the things that people look at in SaaS businesses is something called the rule of 40. The rule of 40 means how well the company is being balancing their growth rate versus their profitability. So for example, something like Adobe. Adobe isn't growing very fast. Adobe's top line is approximately 18%, but its profitability is approximately 23%. So it measures quite well on a rule of 40. Similar with Viva. Viva is one of the ARC investment favorites, and it's similar like Adobe, kind of not growing very fast, but is highly profitable. And then you got the other side of the equation, where you kind of got stuff like, let's say, CrowdStrike, very fast growing, some profitability, but it measures really strongly on the rule of 40. So it's kind of like 80% on the rule of 40. So typically at 40% or even a little bit higher, it's high quality SaaS business. And then you kind of go to something 50%, you're like, wow, this is quite attractive, it's worthwhile holding on to. And then you can go to something like CrowdStrike that is 80% on a rule of 40, and you're like, wow, this is like amazing. You know, it's just kind of, you get very excited and you pay whatever multiple, like any price will do. And then you kind of go to the other side. You kind of have these businesses that are growing reasonably fast at, let's say, 40, 45%, but they're so damn unprofitable that it's like, what's the point? But yet investors for now are all kind of stuck onto this paying up for growth that nobody's going to be asking difficult questions from their investment. But at some point, when the company has to start diluting shareholders, everyone's going to be like, oh my God, what's going on here? What's going on? And that works really well while the market's kind of stable and stuff. But when things kind of, the air comes out of the market, everyone's like, and that company needs to raise cash, everyone's like, oh my God, like it's like sell, sell, sell. So that's one thing that I kind of look at. The other one that is quite helpful to look at is billings. So billings essentially means the company getting cash upfront for a service or access to the platform that is going to be recognized over the next year, or sometimes a multi-year contract. So that's very, very rewarding. First, the money is upfront, so it's very strong working capital. Number two, the company knows how much it's going to be using in terms of costs over the next 12 months, so they can plan, because they are going to be having a certain number of costs to service that customer. So because of having that visibility, they're also able to manage their costs very well. So it's going to be maximized amount of profitability going forward. So that billings is very, very attractive. You want to see billings a little bit higher than revenue growth rates. Why that's important? Because billings is showing you what's coming down the road. It's the pipeline of contracts coming down the road. So if billings are high, you kind of want to see that they're not recognizing that contract too much, because the revenue growth can be adjusted. The management can recognize that or not. So there can be a bit of fudging in terms of the numbers, but you really want to see solid billings growth. The last thing that I think is very helpful for me personally to look at is the free cash flow divided by revenue. So typically, these businesses have a lot of cash flow from operations, but they don't have so much in terms of free cash flow once you subtract out the stock-based compensation. Because these managements, they look out and they kind of pay themselves quite significantly, and that bolsters up the free cash flow metric. But once you remove the stock-based compensation, you may not have that much of a free cash flow generating business. So what I use as a rule is I don't want the cash flow from operation to be more than 25% stock-based compensation added back. So I want to see that the stock-based compensation is approximately 25% of the cash flow from operations, because I don't want to be paying too much for that management in terms of stock. That being said, you want to monitor over a period of quarters how much the stock compensation is growing. Even if the stock compensation is, let's say, 100% of the cash flow, but that's only growing at, let's say, 20 or 25%, whereas the top line is growing at 50%, that shows you the management is driving a very high return on investment. So you're paying them 20% growth year over year, but they're delivering you 50%. That's worthwhile. They can keep playing that game for quite a while. And also, this is not really a metric, but it's something to think about. Typically, but this is something that like you up for discussion, but typically you want to see the management quite significantly aligned with the shareholders. You want to see that hopefully, as the founder has at least, let's say, 3 or 5% of the stock in the company. So these are some of the things that I look at. Now, a lot of these ideas are very much well known, and investors are just really, really crazily paying up for these businesses. So I'll give you an example, right? I have found that if you buy into these businesses that are growing, but the multiple, for whatever reason, at that point in time is compressed, something profitable can happen over the next 12 months or 18 months. So I'll give you an example, right? The trade desk. The trade desk going into May of this year, it's multiple compressed from 30 times forward sales down to 19 times forward sales. Everyone is panicking. How is the trade desk, which is an AdSense company, how are they going to manage to operate in a cookieless world? Investors panicked, but the company is still growing at more than 30% compounded. So if you're able to, sometimes the narrative is kind of overwhelming the stock, and the share price collapse, but the multiple, if you are able to buy into that company when the multiple is compressed and the business is still growing, which the trade desk is still growing for now, even if it dips down ever so slightly, you're getting a very large margin of safety if you're able to buy those businesses and disregard the news, the narrative, because it's quite difficult, but that provides you with a bit of a margin of safety, because provided that the multiple doesn't compress a lot more and the business continues to grow at 30%, in theory, which is quote unquote in theory, that should allow you to have some 30% growth over the next 12 months or so. The problem is when
I was going to say, if you're convinced that the news or the fear isn't real, right? Not that, but the origin of the fear in a cookieless world, it might get affected the business. You're thinking that it won't get affected. So you got to be sure of that. And I'm not sure because I don't know the business. I have no idea about it. But you've got to be sure that perceived risk that the market is now looking at isn't a risk, right? After all.
So two things. The number one thing here is that whenever I look at a share price and it's down 50% from its highs, everyone has asked those difficult questions. Like whatever the bad news is, everyone is pretty much already, the news is out, okay? Everyone knows that things are not so great. The second thing is that, and this is something that we've discussed here in our podcast, is that when you buy a leader, you might be paying a bit more in terms of the valuation, but those people, those leading companies, they know the dynamic way before investors, like way before investors wake up to the news. Those leading companies are already trying, they're already calling up people, negotiating contracts, trying their best. It doesn't always work out. No investment always works out, but typically buying into these businesses that are quite predictable, as long as they continue to grow at a reasonable rate, which is a question mark, maybe the market is right. I'll give you a different example. I own a company called Skills. So Skills is down like 75% or so. Like it's like in this year, it's absolutely been obliterated. And
but did you buy it before the 75% drop or after?
No, I bought it. I bought it probably like it fell 5% that I got involved, and then it like from there on it just kind of kept on going down and down and down and down and down, down. Yeah, it's absolutely obliterated my portfolio. And this is an example of this not working out. And I love talking. The thing that love talking the most about investing is when I've made a mistake. This is something that I'm quite passionate about, because that's the only time you learn. When you buy something, the share price goes up, you haven't learned anything. You haven't asked any difficult questions. When the share price goes down and you've got that loss and you're hurt and you can't sleep properly, that's really when you learn something about investing. And my example of the trade desk, I could have said, oh, Michael, why don't you get involved with something like Skills? So Skills is a company that I do own, and it's kind of like the multiples kept on compressing, and you're like, okay, your theory about it being down 50%, everyone knowing something about it, like it hasn't turned out to be true in this case. So yes, no investment strategy works on every single occasion, but you have to kind of try to get the odds in your favor. Now, then it would kind of bring the next part of the question is, when would something like Skills, it has either, from this point, there's only two levels. It's either going to be a zero or it will be something more than zero, because that's like, it's become so binomial now. Because the top line,
really good one.
The top line is kind of, it's growing at more than 50%.
What's the business? What do they do? Skills?
Yeah, so it's a marketplace where there are approximately 9,000 developers trying to launch a game. So you, Manuel, could make a game, and you'd use the software from Skills, and you would try to kind of put it on their marketplace. And if it seems to get in some traction with users early on, they will promote your game higher. And the more that the users bet, it's a betting game. The concept is that you'd make a betting game, that rewards the players based on skill rather than luck. So most betting games is basically like whatever the game could be, it's basically down to luck. But this one, the idea is that it's skill-based. So if someone like me wants to be really, really good at it, and I'm playing it all the time, I believe I'm quite good, I might be willing to bet on the game, on the Skills platform, to take a gamble or take it up against some other human player. So the one that's more skillful would be rewarded here. So the idea is that at the moment, there's only 3 games that make up approximately close to $1 billion of its revenues. So it has high concentration risk, and the games are very old. They're approximately 4 years old. And the idea from the short side is that the Skills will never, ever have a new game that will be able to replace the churn out from the legacy games. My idea had been, but so far I've been totally wrong, so don't listen to me. My idea had been that you got 9,000 app guys, most of them in like some place that are willing, just determined to kind of get a compelling game out there. Someone may surface a game that is worthwhile, and if that game takes off, Skills doesn't put any investment into that. So you design the game in your spare time, and they don't put any capital towards you. If the game seems to be getting traction on their marketplace, they would promote your game. Again, they've put no capital down, and they would the promotion of the game would bring new users to the platform that would be betting more, that would drive the revenue higher. So that's the idea. So far, this hasn't turned out. The reason why it hasn't turned out is because when Skills tries to promote more users to the platform, they give them some money to new users to come on board, and then the users use the money to bet, and then they disappear. So the economics are very, very, very poor.
It lacks the stickiness.
Absolutely. People come in, they use the bonus upfront cash, and then they disappear. And the games are old. Like there's like Solitaire, there's like Bingo. These are crappy games, several years old. And that's part of why it hasn't worked out in my favor. So going back to the SaaS aspect, this is not a SaaS business, but it's kind of like a business that should be growing at a reasonable rate, and investors should be willing to pay a high valuation premium for a business that has 95% gross profit margins. So yeah, just finish. So most businesses have, let's say, about 70% gross profit margins, or 75. This has a 95% gross profit margin, but the other side of the equation is that they're paying users to come on board. So it's like, it's maybe a bit of the accounting is a bit dodgy. So sorry,
I believe that you have looked at more SaaS businesses than I have. So take what I say with a grain of salt. But one of the things that I would add to your 3 or 4, because you've added ownership as well, parameters that you look for, or metrics that you look for, would be one that it's you can look at it, which is stickiness. You can look at it through churn, right? But this is for me, of course. I would rather pay a higher multiple, all things being equal. I would rather pay a higher multiple for a sticky SaaS business than a high growth SaaS business with no stickiness. And
can I just
of course,
can I just jump in there? So there are 2 types of business models within a SaaS. So you got one where you pay a subscription for the number of seats that you have, and you have another one which is called usage-based platform. So the more that you use the platform, the more that you pay, and the revenue goes up. So in this type of example, for example, Fastly is a business that is a SaaS business. When we went through the COVID spike, the amount of people using Fastly's platform for the internet, Fastly basically connects up quickly different websites to different services around the world. So don't worry about what Fastly does, but it's a usage-based business model. So the more you use the platform, the higher the bill that you get at the end of the month. And you look at this bill and you're like, oh, I thought I only signed up for $100 and now I get a bill for $200. I'm not happy with this. I'm going to churn out. So on the surface, you have a very high dollar-based net retention. So you, as a customer, come in at the start of the month. At the end of the month, your bill is 100% higher. So you look at, for Fastly's, from the Fastly's point of view, the dollar-based net retention is 200%. So it's a very attractive business. But you're going to ultimately, at some point, as soon as you can, you're not satisfied with that. You're going to churn out of the business. On the other side of the equation, you got something, let's say, like ServiceNow. ServiceNow doesn't jack up the price very much on its customers, but their dollar-based net retention is approximately 96%. So it's less than 100. So you'd say, okay, in this example, it's better to pay for a very, very sticky business, but then how do you monitor that sticky business is up for discussion, because the numbers are very easy to be skewed here. And the numbers that the company gives you, it's a bit manipulated. And you look at something like Agora, which the ticker is API. It was basically like the Twilio, Chinese Twilio. I don't know if you've heard of Twilio. This had a very high dollar-based net retention of 170%. Everyone's like, oh my God, this is like the next thing. This is like the next Twilio. But the customers churned out really quickly over the next, like, say, year. But on the surface, at the time, it looked like it could be the next Twilio, and people were paying a very high multiple for the stock. And the numbers looked very, very sticky. And ultimately, we were deceived slightly. And I was a business I was invested in. Thank goodness I didn't make a huge loss there, but that's why I can talk about it. But sometimes these numbers are kind of the stickiness of the business can be slightly skewed. Another thing that people look at is the lifetime value of the customer, how much it costs to get a customer on board. And then once you get the customer, how long do they stick around? And these metrics, management knows that shareholders want them, and whatever shareholders want, they deliver. But they deliver the numbers that might not be actually the numbers that you actually want to look at. It's the Charlie Munger quote, like whatever you incentivize for, you get rewarded for. So
that you've got to do your primary analysis on research on that as well. I'm going to give you an example that is close to me, because I was an architect prior to becoming a full-time private investor. And you've got AutoCAD, which is the software that almost every architect in the world uses, which is made by Autodesk. So after you've taught all the members on your team to learn AutoCAD, and everyone uses AutoCAD in the world, you're not going to change, right? You might, and now there's some other alternatives, but you're not going to switch to another product, even if it's better or cheaper, because you won't go on hours on end again teaching everyone about that. So that's one that I understand. Twilio, for instance, I tried to understand it. I couldn't understand it, so I looked at it like for 15 minutes. But that's where your work really begins, right? Understanding if the numbers that the company gives you are, if you understand them, if they're massaged, if they're not, and if the need for that product and the stickiness of that product in the real world, not just in the annual reports, really exists.
So this is kind of like where I'm kind of, it's always so easy in hindsight. Yeah. And you're going to get one quarterly result. So you're looking at the numbers and you understand the numbers. Let's say with Fastly, I know this company has fizzled out, so I can say that. You kind of look at the numbers and everything looks nice and it's so compelling. And then they miss one quarterly earnings and you're still given the benefit of the doubt. And by the time they report the second quarterly earnings, the share price is down so much. And then they kind of come clean with the accounting, and you're kind of like, yeah, that was what everyone was thinking about. And it's kind of difficult. And yeah, I suppose like at times it looks so easy when it comes to investing. At times it just looks like, yeah, I can see that no one's who wants to kind of in the middle of a pandemic change to their operating system. If you got a website that's up and running, you don't want to have any downtime. You're not going to switch to another provider. Mm-hmm. Yeah, that seems so easy, but then actually the facts turn out that people are quite happy to do so.
That's why this is the they've called it the biggest game ever invented, right? Investing. We're up on time.
Okay.
Love this one, and I think we'll get back. I will get back to this one, the SaaS business and all of this on a future episode.
Thank you so much. Thank you.
Bye.